Thank you everyone for joining our presentation. Hopefully you'll find this really insightful. So this is the agenda that we're going to talk through today. So do a bit of an introduction to Michael and myself. Then we'll give you a bit of a background onto what is catastrophe analytics. Not sure how many people actually understand or know what catastrophe analytics is. It seems it can be quite a niche area of insurance. And then give you some examples. So starting with climate change, so how do we use spatial analytics to make decisions on climate change? And then moving on to an underwriting example. And then finally, we'll pass over to you guys to ask us any questions. So if I start with introductions, so I'm Rachel, and I head up the service offering for EMEA West South. So EMEA West South is kind of UK, France and Belgium, are Southern Europe, so Italy and Iberia, MENA and Africa. And our service offering is anything that's outside of the remit of our normal reinsurance renewal process. So that could be our model evaluations, our model developments, and those types of things. And I've been at Willis Re now almost 2 years, been in the insurance industry around 8 years. So Michael, do you want to do an introduction?
Yeah, thanks, Rachel. Hi, everyone. Afternoon, good morning, wherever you are in the world today. My name is Michael Thomas. I'm Divisional Director in Catastrophe Analytics. I've been at Willis Re for 7 years, and in the industry 9. I started off in the UK team within Willis Re, and I've joined our international centre team focusing on our geospatial solutions, as well as on the side looking at life and terrorism as well. So yeah, thank you, Rachel.
Great. Okay, so let's get started. So what actually is catastrophe analytics, and where does spatial analytics actually fit into that? So with a catastrophe model, we have 4 main components that we think about. And if I start on the top left, so thinking about hazard, and that's looking at the magnitude and frequency of certain perils. So we have both natural catastrophe, so your earthquakes, floods, windstorms, hurricanes, those types of models, and then also non-nat cats, so focusing on life, those types of things as well, and cyber as well. And in that we have our stochastic and historical event sets, which will have been built from all of these catalogues of peril data. So for example, what historical earthquakes have happened, where are those locations, where are those fault lines, all of those types of things. And then focusing on the stochastic section, looking at intensity calculations for those and those perturbations as well. So what types of extreme events might we have in the future? Because obviously from a historical catalogue, we don't have everything there that could happen. Then looking at vulnerability. So this is information all about properties or, for example, cars or agriculture, those types of things, and how vulnerable are those lines of business to an earthquake event or a cyber attack, those types of things. So in that we have different curves that if you have a certain severity, how much damage might you expect from that? And also got to take into account that you might have 2 properties and they might be hit by the same event, but actually they'll have a very different effect according to them. And that could be due to their building type. Are they reinforced with concrete? So we're gathering all this information that goes into the CAT model. Then we have the exposure side of things. So that's where we put in the information from our clients. And that is really all the location information on the property. So is it at lat long level? Is it at postcode level? We might even get it an even worse geographic level. So it could be at a much more aggregated scale, could be at what we call Cresta, which is large postcodes put together, for example, thinking of the UK. And then also in that location area, we also then will gather information that tells you what type of property is it, what construction type is it, what's its roof made of, does it have a basement, all of those types of things. And that will then feed into that vulnerability section that I just spoke through. And then the final main component of a CAT model is the financial section. And that's where you really put in your insurance and reinsurance terms. Do you have like location level limits that if an event happens, then there's a certain cap on the losses that come out. So that all goes into a CAT model, and then that gives us that end loss amount. Now, the areas that have a purple tick, this is where spatial analytics really fits in. And I'll go through and then start talking about, how does climate change really impact those 4 sections. And obviously, if we're thinking about it from the hazard perspective, it's going to go into all of that data that's going into there as well. Okay, so where does climate change really fit in? And if we're thinking about climate change, if we look on the this picture on the left-hand side, this details really what we're expecting with climate change. So we're going to have an increase in the mean, so that bell curve is really going to shift to the right. We're going to expect more hot weather and more extreme hot weather as well. It could be an increase in variance as well, so that curve is really going to start flattening. So we're going to get more on the extremes on what kind of weather events we might expect. And then finally, an increase in both that mean and variance. So, it's that curve is squashed, and then it's also going to be shifting to the right. So you can see how all of those things are going to really impact those events that we have in our CAT models. So obviously, as you're building that hazard component, you're going to want to take into account what might happen to all of those events, where your tracks might change, how much precipitation is happening, if it's a flood model. And then if we're looking at the graph on the right-hand side, so this is where we actually have, a greater understanding of some events. So your extreme heats and your extreme colds, we understand the climate change influence on those, and we are able to detect those signals in the data. But there are lots of events and perils that we still don't really know whether they are going to increase or they're going to decrease. And that can make it quite difficult to try and take that information into account when building a CAT model. Why are we really interested in this in the reinsurance industry? And we're going to look at a case study of the UK, and this is, we've done quite a bit of work on the UK, and it's also a territory that's really leading, kind of looking at climate change and stress testing especially. There's 3 main sections, and firstly, the mandatory climate-related financial disclosure that companies have to report on. And now for the UK, firms should have a really embedded climate-related financial risk focus. And that's a kind of board level. And then the 3rd section, so stress testing. And this is the main section that we're going to carry on talking about in this presentation. So in 2019, there was the PRA General Insurance Stress Test. And you can see on the bottom right, we have the table of the stress tests that our clients were asked to respond to. And then in 2021, we're expecting that these are going to be updated. They could be, slightly changed on this, but hopefully we'll follow the same structure. So this is just looking at the UK. There was also stress tests built for the US as well, but this is just for the UK. And it's split into 3 sections. So you've got your sudden transition, your long-term disorderly, and your 4 degree, so degree scenario as well. And for the 4 perils, in quite a basic sense, they were split into how would you see those increases? So would it be, an increase in precipitation, an increase in the storm surge levels, for subsidence, what's the increase in your claims? And then finally for freeze, an increase in the claims as well. And from that, I'm going to talk then about flood and a little bit later on, but also talk to you about what kind of spatial data would we use when we're building those solutions to answer those stress tests. So for flood, we would look at things like river gauges. And for the sea level rise, sea level gauges. For subsidence, we look at things like temperature gauges, the soil data. So is it in a clayey area? Is it in a better kind of soil that wouldn't have your shrink and swell? How much vegetation is there? Because that also affects your shrink and swell. Temperature gauges as well for freeze, very important. So that's all the hazard data. And then if you're looking at your vulnerability data, building characteristics, what what construction is it, those types of things. Flood defense is also very important for your flood and sea level rise scenario. And then finally, the client data. So going back to the CAT model drawing, so those exposure locations, where actually are they situated? Are they close to a river? Are they close to the coast? What kind of information do we have on those exposures? And then finally, if we have some claims data, that's really good to actually validate and calibrate these solutions that we're coming up with. Okay, so our flood scenario. So this is, again, for the UK, and we have built this with Newcastle University, which is one of our Willis Research Network partners. So the Willis Research Network, in a nutshell, is our kind of scientific collaboration. So we've got lots of institutions that partner with us, and we work on different projects with them. So this was our flood solution. So you can see we've got the river gauge data that I spoke about in the previous slide, and we will graph that information up and try and work out actually where are those storm water levels. Is there a certain threshold that they're going above? And then looking at that percentage increase on those river catchments, trying to work out what those return periods would be. And if we're just quickly looking at this image on the right-hand side, we specifically chose geographically relevant catchments. And that could be, to work out which ones are geographically relevant, having a look at spatial data in that, how close are they to lots of different catchments? Are they representative of where people are living? What types of soils are in there? All of those kind of things that would affect things like your drainage and how water might pool in certain areas. So going back up to this section, so I'm jumping around a little. So once you've calculated that percentage increase as from the table on the different scenarios, so say it's a 5% increase in your precipitation or 15% increase in your kind of mid climate change scenario, you're just trying to shift up those water levels to try and estimate actually what would that scenario be like in a climate change kind of system. And then we have on this bottom, we have an exceedance probability curve. So at certain return periods, what loss are we really expecting? And then from that, we're trying to get that impact of, okay, well, the purple is our baseline. So with our yellow line, that's the percentage increase. And you're just seeing how those losses are really going to shift up. And then we would scale that up to a countrywide portfolio. So every single catchment in the UK. And then the output, we can then know, okay, well, you might have a 1 in 100 year loss, which is here. And then actually in the new scenario, for a 1 in 75 year, we're actually getting greater than a 1 in 100 year loss, which obviously for clients in the insurance industry, that's problematic. We're going to be expecting those flood events to come around more frequently. So that's not good, and our clients will have to hold back more capital. So all in all, when looking at climate change, there's so much spatial data that you can take into account. And obviously, this is just one of the scenarios focusing on flood. But it's something that continuously we're looking at where can we take more spatial data and try and enhance these scenarios. So I'll hand over to Michael now to talk through our underwritings.
Cheers. Thank you, Rachel. And similar to what Rachel was touching upon, what is Catastrophe Analytics? We're going to start with, well, what is underwriting? And it's the process through which insurance companies identify which risks are acceptable to cover. And then if we think about the pricing side, coming up with what price that should be. Focusing on Catastrophe Analytics, we mainly focus on the spatial risk piece and looking at hazard information. Again, as Rachel touched upon in the sort of Catastrophe Analytics CAT model framework, we look at the perils such as earthquake, hurricane, windstorm, and flood, to name a few, and use that to assess the immediate risk. We obviously work on calculating a premium which is appropriate to cover the risk posed and any possible future claims. But if we think about how we're going to adopt that spatial data, that spatial risk data, how are we going to do that? There's many methods of doing that, and I guess those differ across a complexity level, but also across implementation level. So if we think about categorical risk to start with, that is relatively straightforward. That might be taking some flood hazard information, some flood hazard maps, and categorizing the flood risk water depths into a risk score from, say, 1 to 5. And the reason that we would do that is to make it simple for non-experts within, this sort of perils to utilize that more efficiently, but then also group that up or aggregate that up into some sort of admin boundary level, such as a postcode, so it can be easily adopted within a pricing platform. So, for example, you wouldn't necessarily need to have a map of postcodes and a risk score. You could easily have that as a CSV file or an Excel file and integrate that into your pricing network. If we think about relative risk, that might be looking at, you have a average annual loss that you believe to be at the national level, and then you distribute that across your portfolio using a hazard-based layer based on the information in that. And that's a quite good way of differentiating regions from high to low risk. And then finally, probably the most complex one is looking at absolute risk, and that is, identifying the pure average annual loss that would be calculated for an individual location or for an individual postcode, and utilizing that within your pricing model itself. That obviously comes with a lot more complexity, and there's a lot of factors to it that are involved with that. Hence why it's, our largest pyramid there. But if we move on next on to sort of our main piece of the presentation today on underwriting, spatial analytics is becoming an integral part of underwriting and the pricing, business decision framework. And if we look at this workflow here, it all starts with the exposure, and this has similar links to the CAP model framework, but works in a slightly different way. But if we look at exposure to start with, that if we're thinking about property risk, we're thinking about the location of where that is, also the attributes associated to that location. So if we think of a house, is it detached? Is it 2 stories? Is it, what sort of roof does it have? And so on and so forth. And all of this information can be added to that location to better quantify risk in a number of different ways. Obviously, we've touched on this piece, risk data, the natural perils suite, and this is where this comes in. But you also have the non-nat peril piece, so if you have fire and theft as well, which would go into that in addition. Then if we look at the risk selection and pricing models, one component of that is the geo-visualization piece. I talked about just having a CSV based or, postcode level Excel data. Obviously, a geo-visualization component to your pricing platform is very powerful for you to look individually at risks and identify with your own eyes or for the underwriter's own eyes, what is the risk deemed for that location. You then have integration of historical claims data as well as the actuarial pricing model to develop your own view of risk. And this is what the insurance industry has been doing for some time now. But if we think about the core business applications here, it's around risk selection. So you can do that through automated APIs. You can do it through individual referrals to underwriters. But then you have the risk reflective pricing component, which incorporates all of what we talked about, exposure and location risk data, along with claims to come up with a risk reflective price. But it's not just about the front end of insurance, it's also at the back end, or if you think through the insurance cycle, you've got the portfolio management, so utilizing geospatial platforms to look at adverse risk concentrations. Insurance is all about the not having all your eggs in one basket. So being able to diversify your portfolio from a geographical basis is obviously quite critical, and this is where these tools come into play. You then finally have, utilizing all this information to make risk transfer decisions, and that's what do we mean by that? We mean reinsurance being, a main component of that, and that's where Rachel and I play on a day-to-day basis. But I think the key theme here, and we've mentioned it before, is a growing trend towards risk reflective pricing. Next slide, please, Rachel. So we're going to go on to a case study now. We're going to move from the UK, we're going to go to Australia, and we're going to look at Australia flood. And just wanted to start on the model approach. So how do we quantify flood risk in some way? And in basic terms, we've come up with a flood hazard model, and there's a number of components to that. You've got your rainfall grid, so that's looking at geographically where you're going to have the most amount of rainfall in your geographic area, but also the duration of that and other components. And then you need to link that up with a terrain model, because you need to know, okay, well, once water hits the ground, where does it flow to? So you need to identify where that goes, and you can use 2D model simulations of your river network to identify where those are going to go. And then finally, that gives you your sort of flood hazard map. You can incorporate defense data as well to improve the view of risk that you're coming up with. And then if we think about the categorical risk component that I talked about before, well, how do we convert all that great hazard data that we had into a risk score? And essentially, we work from the grid. So typically the models that I was, the flood hazard model that I was talking about just previously, that's on a grid level. Typically that's a 5 meter to 30 meter resolution. And we'd convert that using a risk matrix into risk scores. And we'd do that for one return period, but then we'd do it for multiple return periods as well, because we're interested in the severity of the risk. So how deep is the water, the flood water, but then also the frequency. So when is it likely to happen? What sort of return period levels are we talking? And then there's a number of different ways that you can incorporate that at an admin boundary level, but one simple way would be the average risk score across a postcode, and then you can assign that as your final score at a postcode level as well. So finally, moving on to the final slide, looking at sort of the business application of this in some more detail, sticking with Australia, obviously. Recent events have really challenged the policy terms and led to an evolution of flood cover in Australia. There was the Brisbane floods in 2011, which weren't covered by insurance companies, albeit policyholders thought they were, and this really led to reputational damage. And the regulator had to step in and say, insurance companies, you're going to have to pay for this, because this is quite extreme, and that led to ex gratia payments, and this really impacted the insurance companies down there, down in Australia, hitting their bottom line quite hard and their overall earnings and profit for the year. And so, obviously, the reputation and relationship with with customers around Australia was not great, and they thought, well, if we're going to take this on as risk within the market, we've got to be able to accurately price that and assess flood risk in an appropriate way. And we've come up with our own flood model for Australia, and we've been helping clients since 2011 in their risk selection and risk pricing. But I just wanted to finally end on one case study here. We had a client implement our flood data in 2012. Throughout that year, they were declining high-risk policies at renewal, based on just they were too risky to take on. There was unfortunately an event in 2013, but looking back at the policies that they declined, they'd saved several millions in claims, and they were able to showcase this to reinsurers and also make savings on their reinsurance spend as well by demonstrating this portfolio optimization. So this is a great example of seeing impact that you make at the front end of your insurance business, and really that flowing through your risk management framework and also into your capital strategy as well. So that's where I wanted to finish on, and we'll open up to the floor to questions. Thank you very much.
Hi, Michael and Rachel. Thank you very much for this presentation. It was really interesting. And for someone who isn't that all but aware of the reinsurance world, it was a really great introduction and to understand the ecosystem. I can't see any questions on the chat right now. Oh, here we go. We do have one from Spring Bay Nema. sorry if my pronunciation's off there, but do you feel current CAT models being used by insurance underwriters appropriately reflect the increased risk of natural disasters due to climate change? In other words, is the industry keeping pace with the science?
I think it's an area they're working on. Obviously, the data that sits in the models is mainly historic data, but obviously there is a stochastic component as well, which those events could be capturing some of that climate change component. But all in all, it's an area that they're working on to continually, add a climate change component. So you'll be able to switch on certain buttons and include time slices of different climate change projections. So yeah, it's being worked on.
And then we have a question from James Cutler, who is asking, we know that postcode-based risk scores are fraught with their own risk. Are you, and is the insurance industry moving quickly enough to a more granular address property level scoring model?
So I'd say for the UK, definitely. And I think there's another question coming up on UPRNs that we can touch upon. But yes, certainly for the UK and in well-developed markets, but still we're seeing in emerging markets such as Latin America and also around Asia that postcode information is still being used. That is the main basis of their view of risk, even at more high level things, even at city. So it still can be quite basic, but certainly it's moving in the right direction towards address level.
Okay, great. Well, thank you both so much for joining today.